Welcome, financial wizard and investment Jedis. Today, we're venturing into the thrilling realms of ETFs, or as I like to call them, easy treasure funds. I'm Jake, your guide to turning the stock market from a confusing maze into a fun financial amusement park. ETFs are like the celebrity entourage of the stock market. Imagine a financial boy band where each member has its own special talents. One's great at tracking indices, another is a pro at diversifying risk, and there's always that one rebel trying to outperform the market. It's like assembling a dream team of investments, but instead of paparazzi, you've got expenses ratios chasing them around. In the grand theater of finance, ETFs are the versatile performers, ready to rock your portfolio without demanding a diva level salary. They are versatile because they are big baskets of stocks that can go from a couple to more than 10,000 in them. They are designed to mimic the composition and performance of a financial market index. For example, you probably already heard of the popular index SP 500, which is one, if not the most popular, well known index fund in the world. This fund tracks 500 of the largest companies in the United States. There can be a lot of reasons as of why a stock is added or removed from an ETF depending on the type of funds. Think of adding stocks to an ETF like throwing ingredients into a financial blender. You've got your high flying tech jobs, the classic blue chips, and the sprinkle of small caps for that extra crunch. It's the ultimate smoothies of the stock market. It's like creating a perfect financial salad, and each stock is a leafy green, bringing its own flavor to the mix. Salad and ETFs are alike in their composition and customization, just as the salads offer a mix of fresh ingredients that can be tailored to individual taste and nutritional needs. An active ETFs combines various assets managed by professionals to create a unique investment blend. Just as a salad ingredients can change based on seasonality and personal preference, an active ETFs portfolio can be adjusted by fund managers in response to market conditions and investment goals, offering a dynamic and adaptable investment option. Here, we're talking about active and passive ETFs. What does this mean? Well, these funds can be passively managed, which means that their managers are not trying to time the market or make plays in the different economic cycles. They choose the companies in the index and will sometimes add or take off some of these companies for different reasons. They can also be actively managed. As with any ETFs, a benchmark index will be present in the actively managed ETFs, but managers are free to alter sector allocations, make market time trades, or otherwise vary from the benchmark index. As a result, investment results are often not an exact replica of the underlying index. Alright, let's break down the different types of ETFs in a way that won't put you to sleep faster than counting sheep on Ambien. Equity ETFs, the Hollywood celebrities. The equity ETFs are like the Hollywood A-lister of the investment world. They are the George Clooney and Scarlett Johansson of the stock market. You invest in these guys when you want your portfolio to walk the red carpet of Wall Street, turning heads and making headlines. Equity ETFs invest in a basket of company stocks. They allow you to hold a portion of hundreds or even thousands of firms in a single trade and are the most popular sort of index traded funds. Bonds ETFs, the retirement planners. Bonds ETFs are the responsible adult in the investment family. They are like your financial retirement planners, wearing glasses, crunching numbers, and making sure your portfolio gets a cozy, well deserved nap. Think of them as the grandparents of your investment strategy, steady, reliable, and occasionally ending out financial advice over a cup of chamomile tea. They provide steady returns at potentially lower risk than equity ETFs, so it's a good solution if you want to diversify from stocks only ETF. Commodity ETFs, the farmers of finance. Commodities ETFs are like the farmer of finance. They are there in the fields planting seeds in the form of gold, silver, or maybe even soybeans. It's like having a mini farms in your investment backyard, where your money grows like crops, just without the dirt under your fingernails. Commodity ETFs work like industries or sector-specific ETFs, but with commodities. They could follow the price of gold or oils, for example. Currency ETFs, the jet-setting globetrotters. Currency ETFs are the jet setter of the financial world. They are the globetrotters, changing currencies like some people change clothes. Investing in these ETFs is like sending your money on a world tour. Currency ETFs can invest in a basket of currencies or a single currency, such as the US dollar. The ETFs may invest in the currency directly, indirectly, through derivatives, or both. Inverse ETFs, the rebels. Inverse ETFs are the rebel of the bunch. When the market goes down, they go down. And when everyone is screaming buy, they're whispering sell. It's like having the punk rockers of finance in your portfolio, flipping the birds to market trends and doing their own things. You could buy this if you think, for example, that the price of gold will drop in the future, but you're not sure what you should do to specifically achieve that goal. You could then buy an inverse ETFs based on gold, which is a lot simpler than shorting the gold sector itself. So, there you have it, the ETF family, from Hollywood celebrities to rebellious punks. Each type has its own role in the financial sitcom of your investment journey. Now, go out there and build your ETF dream team. Don't forget to comment, like, and subscribe if you've liked the video and want to learn more about investing. Have a great day, everybody. Thank you.